So the CARES Act has an impact on the FAR exam with net operating losses. As you know, COVID-19 resulted in massive business losses in 2020, and that resulted in companies paying no income tax because when you have a loss, you don't pay any tax. But that did not free up needed cash. So President Trump and Congress decided to allow companies that had NOLs in 2020 and even 2019 and 2018 carry those losses back 5 years to the oldest year first to get a tax refund for taxes paid in those years. So one of the things the CARES Act did was it reinstated the NOL carryback, which had been terminated under the Tax Cuts and Jobs Act. Another thing the CARES Act did was it temporarily suspended the 80% limit on the net operating loss rules. So here's what we have now. A net operating loss that arises in either 2018, 2019, or 2020 can be carried back 5 years to the oldest year first and then carried forward indefinitely to offset taxable income in other years. And that's supposed to free up the cash so that businesses can get their hands on some of the taxes that they paid in previous years now that they have these losses. And the NOLs utilized in the 5-year carryback period, they're not subject to the taxable income limitation because we said the CARES Act temporarily suspended the 80% limit that was put in by the Tax Cuts and Jobs Act just a few years ago. So the goal is for businesses to get their hands on needed cash. So that's why they suspended the 80% limit temporarily. So if you take your net operating loss back 5 years, you'll be able to wipe out 100% of taxable income, not just 80%. As long as that loss is carried back in 2018, 2019, or 2020, any loss you had in those 3 years can be carried back 5 years. And those years ago that you're carrying back to had a much higher tax rate. NOLs carried forward to taxable years beginning in 2021 or later, that's when they bring back the 80% rule. So 80% of taxable income limitation will come back in 2021, but not for 2018, 2019, and 2020. Taxpayers can elect not to carry back and just carry forward, but most businesses are carrying back, and you can see why, because they paid taxes in previous years. Now they have these losses because of COVID. They want to go back to those years and get a refund from IRS. What about NOLs that arise in 2021? Well, they can't be carried back, only forward. So it's very important to note that if the NOL arose in 2020, you can carry it back. But if the NOL came along in 2021, you can only carry it forward. And as a result, book income and taxable income will differ in the years in which the loss is incurred and the years that the loss is carried back or forward. Let's try this question. What impact did the CARES Act have on a corporation's ability to carry back a net operating loss incurred in 2018, 2019, or 2020? A says the CARES Act eliminates the 2-year carryback. No. B says it allows the loss to be carried back to any of the 5 most recent years. No. It does allow for a 5-year carryback, but that's to the earliest possible year. Check out letter D. So what impact did the CARES Act have on the taxpayer's ability to carry back a net operating loss incurred in 2018, 2019, or 2020? It allows the loss to be carried back 5 years to the earliest possible year. For example, a corporate NOL from 2019 can be carried back to offset income from 2014 first, and that was probably subject to a 35% tax rate. Why? Because that's what the tax rate was back in 2014. So let's see what would happen in a loss carryback from 2019 all the way back to 2014 and what the journal entries would look like. So if Getty Corp incurred a net operating loss of $130,000 in 2019 and it could now be carried back because of the CARES Act, it'll go all the way back 5 years to the earliest possible year, which is 2014. And let's say that year they paid 35% in taxes. So if the carryback to 2014 results in a tax refund of $45,500, this would be the journal entry. Debit tax refund receivable, that's a current asset. Credit income tax benefit. So it's this tax refund receivable right here that the company is going to set up and wait for a check from IRS as a refund of prior taxes paid. Let's try this one. Lourdes Corp suffered a net operating loss of $50,000 in 2020. Lourdes Corp had no taxable income in 2015. Right? If you carry it back 5 years, there's nothing there because they had no taxable income. And they had $40,000 of taxable income in 2016 and 2017. According to the CARES Act, how much of the current year NOL can be used to offset taxable income in 2016? And the answer would be you'd carry back that $50,000 first to 2015. There's no taxable income there. And then you'd go to 2016 and you'd be able to offset $40,000 of taxable income. So it would be choice B. The CARES Act temporarily removed the 80% limit for taxable years beginning before 2021 to allow the NOL carryover to fully offset the organization's income. How about this one? Net operating losses incurred in which of the following years are not eligible for a 5-year carryback? And that, of course, would be 2021. So letter D is the answer. NOLs incurred in 2021 must be carried forward, and they can only offset 80% of income. Now we're going to look at an example where you have an NOL carryback, but you don't use it all up when you carry back, so you'll have some left to carry forward. We're going to look at the journal entries and what it looks like on the income statement and the balance sheet. The facts tell us that in 2017, Horace Corp began operations and had book income equal to taxable income for each of the years below. So that means there were no permanent or temporary differences. So in 2017, they had income of $40,000 and they paid a 35% tax on it. In 2018, the Tax Cuts and Jobs Act came along and slashed the corporate rate to 21%, and they had income of $60,000 that year. They paid 21% tax on that. But look what happened in 2019. Big fat loss, $240,000 loss. They would have paid 21% tax if they had income, but they didn't have any income. Then in 2020, they're expected to have income, but not beyond 2021. And the tax rate is expected to be 21%, already enacted at 21%. So let's see what we do when we carry back and then carry forward and what the journal entries look like. So the first thing we're going to do is recognize the fact that we have a $240,000 NOL in 2019, and we're going to carry that back to the earliest possible year, which for us, even though it's a 5-year carryback, they've only been around since 2017. So you'll carry back to the earliest possible year, which is 2017, at which they had $40,000 of income. So we carry back $40,000 to 2017. We carry back $60,000 to 2018 because that's how much income they had in those 2 years. So you can see that we used up $100,000 of the $240,000 NOL just by carrying back. So we'll have $140,000 to carry forward to 2020 and future years. Now, first the carryback. $40,000 goes back to 2017 where we paid a 35% tax. That's a total of $14,000. We're going to ask the IRS if they'd be kind enough to refund the $14,000. 2018, we're carrying back $60,000. In 2018, we paid a 21% tax. So that means we paid $12,600 in taxes back then, and we're asking the IRS for that amount of refund. So the total income tax refund that we're waiting for from IRS, $26,600, and we'll record that as a receivable. So let's review what we did so far. We had a $240,000 net operating loss in 2019. We carried $100,000 of it back. $40,000 went back to 2017, $60,000 went back to 2018, and we wound up with $140,000 to carry forward. The carry back works out great because it's going to result in a tax refund of previous taxes paid. Right? In 2017, we paid $14,000 in taxes. We're going to ask for that back. In 2018, we paid $12,600. We're going to get that back from IRS. A total of $26,600 we're expecting to receive as a tax refund. Now here comes the hard part. You know the $140,000 that we're carrying forward of the $240,000? The $140,000 that we're carrying forward, we may not get to use it all. Because the only benefit of a carry forward is if you're going to have future taxable income. Well, it looks like in 2020 we'll have future taxable income, right? $50,000 is expected, but not after that. So that means we're only going to use $50,000 of the $140,000 carry forward. If we didn't have to worry about how much we were going to use or not use, we would just take the $140,000 that we're carrying forward and multiply it by the future enacted rate of 21%, and that would be $29,400 of what we would call a deferred tax asset. The problem with recording a deferred tax asset for $29,400 is it's based on $140,000 of net operating loss, and we know ahead of time we're not going to use all that. So what do? Well, if we subtract the $50,000 of income that we're expecting in 2020, that leaves $90,000 of a carry forward that we're never expecting to use. And that times the 21% enacted rate would give you what you call a valuation allowance for your deferred tax asset. It's a contra asset, in this case of $18,900, which works against our deferred tax asset of $29,400. All right, allow me to bring in this journal entry where we're going to debit deferred tax asset for $29,400, but we're going to credit the deferred tax asset valuation allowance of $18,900. And then if you remember, we have that receivable. We're waiting for an income tax refund from IRS of $26,600 from the 2 years we carried back to. So that's a debit to income tax refund receivable. And then we would plug the income tax benefit here for $37,100. That's just a plug figure. So they used to love this question on a CPA exam where you would carry back an NOL and then carry forward. And then when the Tax Cuts and Jobs Act ended the carryback, then all you would do was carry forward. But the CARES Act brought it all back again, so they could ask it again. So now we're ready for it. So notice what we calculated and what we didn't calculate. We calculated the refund receivable to be $26,600. That's a current asset right here in our journal entry. We also calculated the deferred tax asset, the gross amount, based on the $140,000 that's going to carry forward times the 21% enacted rate. Then we had to set up a valuation allowance. Why? Because when it's more likely than not that the deferred tax asset won't be used, you need a valuation allowance. But we did not calculate the income tax benefit, we just plugged it. Now the deferred tax asset is a non-current asset, and if it was a DTL, it would be a non-current liability. But whenever you have a carry forward, that's always a deferred tax asset, and all deferred tax assets and liabilities, they're always non-current. But this income tax refund receivable, that's current. We want that from IRS right away. We expect that as soon as possible. One other thing the exam could have asked for here, the net realizable value of the deferred tax asset would just be the $29,400 gross amount minus the valuation allowance, or $10,500. If they would have asked for the net realizable value of the deferred tax asset, you would tell them $10,500. So they could ask you about the income statement, about the balance sheet, and how the income tax provision would be shown. In this case, it would be an income tax benefit rather than an income tax expense. So you have income tax benefit on the income statement. Current benefit, $26,600. What's that? That was the income tax refund receivable. That's your current benefit. Your deferred benefit is $10,500. Put it together, there's the $37,100 that we plugged to income tax benefit. The balance sheet has a current asset, the $26,600 refund receivable. It also has a non-current asset, the deferred tax asset. Net realizable value, $10,500, because we had to subtract the valuation allowance from the gross amount.